Hey everyone, this is Peter Kim with Ascent Equity Group. Just want to make sure you're in the right place. This is a presentation that we're going to be talking about an exciting opportunity that's called the Cabana Encanto. That's a property in Goodyear, Arizona. We're going to talk about all these things, but we want to do our best to give you a high-level overview of this project, of this opportunity, so that you can make sure that you know whether it might be a good deal or an opportunity for you, considering your goals and objectives, considering your portfolio, and see if it might make sense for you, especially if you're interested in investing in passive real estate investments like syndications. We're going to do our best job today. Myself, my partner is Pranay Parikh, Myth Jagapragasan. You're going to see us all talking on this webinar. You're going to get this as a recording. You're also going to get a copy of this, what's called this offering memorandum or deck. So you'll have that available to you to look back on whenever you want to take a look at that. So let's just go ahead and dive on in. But before we do that, I always like to start with a little bit of a disclaimer, and I think it's important to do so because there are going to be a lot of things talked about in this deck. There are going to be some projections. There are going to be some numbers, some information and data. And just want to let you know, we're doing this to the best of our abilities, especially these forward-looking projections. Please do not take any of these as guarantees. Take a look at this disclaimer in the memorandum in the deck just to get a fuller a look at what we're talking about here. There's some terminology that we're going to be using that, again, is explained maybe a little bit better in this disclaimer. And again, none of this is guaranteed, and just know that the information in this is confidential. And so we're sending it to you. Take a look at it. And we'll do our best to present this in a way that is best understood. And if you have some questions for us, make sure we're going to make sure you have an opportunity to ask us as well moving forward. Okay. Again, this property, it's a 286 unit property in an area called Goodyear, Arizona. We call it the Cabana Encanto. We think, and we're super excited because of this area that it's in. We have many area properties in this area, and this area particularly is called the West Valley. It's one of the most affluent areas, and we think in terms of an opportunity, you can take a look at the beautiful pictures themselves, that this is an opportunity that many of you would love to invest in. This was built actually relatively recently in 2022. A developer took it on, built this property, and has started to lease it up. And it really has presented a great opportunity for us to step in and take it further from here. Our goal is to provide the residents of this area with a product that maybe they don't or that isn't existing right now for them. It's an alternative to it's high quality housing, you can see, obviously, but at a very, very affordable price. And then we'll talk about how we're able to do that without compromising any of the high standards that many of the people in this area would come to expect, especially when they want to get into a nice property like this. Just so you know, we're buying this property for what we say $222,000 a door. And why that's so important is that it's such a what we call a low basis. We're getting in at a great time in the economy, in the market right now. In fact, we're basically getting a 20 to 25% discount from where this property used to be. And I think in this time, those are the deals that we're looking for, opportunities to get in, to take advantage of what's going on in the market today, to really set us up for future success. And that's why we're super excited. I mean, if you're going to get into a property like this, instead of paying $222,000 a door, you'd have to get in at $320,000 a door for many comparable properties. And again, this is why we're so excited that the rents we can charge will honestly be able to beat the rest of the market in terms of what people are able to get for that price, which puts us in a great position to really capitalize on all the amazing growth and the great things that are happening in this area. This is new construction, right? So only from a couple years ago, in fact, a year ago. And it allows us to kind of not worry about some of the maintenance costs and things that we normally look at when we do a lot of these value add opportunities. So we're going to talk a little bit about this. Ascent Equity Group, to be very clear, it's consists of three major partners: myself, Peter Kim, Myth Jagapragasan, and Dr. Pranay Parikh, all of us, and probably you know very well. So again, this is the Cabana Encanto. You can look at it, the styling, and this is very accurate. This is kind of a rendition, but you can see how unique this property looks and how modern it looks. Again, we're going to be going through a bunch of things in this deck. We talk about the overview here. This is kind of some interior images of what some of these units look like from a stylistic point, from furnitures. And again, this is the executive summary. We're going to be talking about the high level overview. Again, talk about the market, talk about why we think this is an exciting opportunity, and what investors can expect from this. Here's some other great pictures of the interior. Again, this modern styling, this is new construction. This is what people come to expect when they move into a high-end apartment type building these days. It's probably something you and I would expect, people that are watching this. And this really is really tastefully done, and we're super excited by it. So again, this is a 286 unit property in Goodyear, Arizona. I talked about the discount. We're getting this at a $20 million discount from when this property used to be last year, from all opinions that were given last year, broker price opinions. We think that, again, because we're getting in what's called this basis at this price, we're able to outcompete other buildings and opportunities in this area. We're able to set our rents at ones that are affordable, but also, again, ambitious, but also, again, very attainable for people in that area. And we're able to beat other products in that market. One of the exciting things about this, and I'm going to talk about debt later, but we're going to be putting long-term fixed debt on that, especially in today's age, in today's market. We all know that security and reliability and consistency is something that we can all value quite a bit. You probably heard about a lot of things that are happening in the market, especially when it comes to debt. When it comes to mitigating risk, really being able to control your debt and understand that is paramount. And so we're getting this with long-term fixed debt, so we know what the costs are there. Again, this cap rate that we're getting at, we're going to go into that a little bit later. We think it's a fantastic price, meaning that the returns on this is something that we can, again, from day one, are things that we're excited about. The purchase price here, just so you know, $64 million. Again, it was initially valued in the $80 million range. We're getting for $222,000 a door. And we expect somewhere in the 13 to 15% returns for investors. Again, some more pictures of the interiors. Hopefully some of that speaks to you and appeals to you. For me, it feels like a place that I would live. And here are some of the reasons why we like some of the property. Again, high-level overview. We think the area that this property is in, the Goodyear area, has a lot of things going for it. You want to be in an area that has strong economics, strong economic factors in terms of winds at your back, not in your face. And here are some of the reasons. Here, strong employment numbers. The unemployment rate in this area is lower compared to even other areas in the area in terms of the neighborhood. And the reason why is there's such strong job demographics here and strong job opportunities. It's an industrial hotbed. That's what they say. There is a ton of jobs in this area when it comes to tech, when it comes to healthcare. There's the military there in terms of the Air Force Base, and the quality of life is known to be really, really nice in this area. There are a ton of upscale accommodations, entertainment, recreational areas like parks, and again, known to be a very beautiful area to live. There are some other, you can see some everyday essentials, some entertainment in that area. And so because of that, it's become a very, very desirable place to live. And this property is so well situated, right smack in the middle of that in terms of the future growth. Here's some, again, pictures of what the interior will look like. You can see this is modern styling. Again, the floors, when you look at the cabinetry, all the furniture, but again, all the kitchen, kitchen appliances and all of that makes for a very, very simplistic but modern type of amenities and type of place to live. And here's some other pictures. Okay, so just starting out with returns and what we anticipate our expected returns for investors. Many of you have asked about these, and we're excited to announce this and talk about this. We expect that the IRR, the internal rate of return for investors, I'm talking about net, this is to you, is expected somewhere in the 13 to 15% range. We expect a 5-year hold on this. We think that's the right time considering where we are in the market and economy. And we think by the 5-year hold with that is where we'll ultimately end up with an equity multiple of 1.8 to 2x. That means that at the end of this deal, the anticipation is that you will have 1.8 to 2 times the amount of capital that you put in, all things being said and done. And so these are, again, in this time, we're excited that we can kind of present these metrics. And then again, that's a reflection of the price we're buying it at. We expect this thing to cash flow immediately. And for many people, that's what you're looking for today. You're looking for that immediate cash flow with your investments. And because of the type of property, because of the rents, because of the debt that we're going to put on, the expected cost, we're highly confident that in year one, we're going to get 3 to 5% in terms of cash flow for investors, for investors in that first year. And it's going to go up each year, 4 to 6%, 6 to 8% for years 3 to 5. And those are things that we're excited to talk about. All right. Annual occupancy rate. I think it's important to talk about this because people want to know, what does the surrounding area look like in terms of rent right now? You've probably heard a lot about migration patterns from high cost of living areas to areas like Phoenix, and it's become a hotbed because of new jobs. Again, a thriving, a thriving life in terms of lifestyle for especially young people of working age. And so you can see the annual occupancy rate here for the general area. You can see a dip there in 2008, 2009, and since then it's come on strong. And it's only continued to grow as people have migrated to that area and they've stuck around because of the lower cost of living, the good lifestyle, the amenities in that area. And you can see now it hovers in the 96 to 97%. And they anticipate that to remain strong here on moving forward. The thing we always look at when we look at deals like this, we look at something called break-even occupancy. What would our property look like, or how well could it perform if things did change? And you see that 2008, 2009, we always worry about in some sort of unforeseen economy, which actually I wouldn't say unforeseen. We anticipate things to go down. Everyone knows that we're possibly heading towards a recession or that sort of thing. Will we still be safe? Can we mitigate that risk if for some reason the occupancy rates drop? And so you can see even in the 2008, 2009, 2010, they dropped in the high 80s range. Well, we determined using our underwriting, we looked at the numbers, our break-even occupancy starts at 61%, meaning that even if occupancy dropped all the way to 61%, that's when we would start having some difficulty with our properties. And you've seen historically, you can see the numbers here. There's nothing, basically everything has hovered 90% or above, and even that. But the way we've set things up here in terms of mitigating risk, 61% is where we would have some issues doing that. And we don't anticipate that happening moving forward. This is a new property. The area is strong. The economic factors are moving in our direction. And you can see that break-even occupancy, in fact, goes down year after year after year. Hopefully that gets you excited about this opportunity. I'm going to now turn it over to one of my partners, Dr. Pranay Parikh. He's going to take it from here and tell you about some other interesting parts about the deal, things that you might want to know about. So Pranay, take it away.
Thanks, Peter. So we're super excited about the deal, and I kind of want to just go through some specifics of what we really like about it. So it's brand new construction in 2022. We're actually buying it directly from the builder. So that means a couple things. That means the maintenance requests are going to be very low. We're going to need less repair people, and there's going to be less repair requests. Also, major things are covered under warranty, like air condition and roofs. It's a Class A property in a Class A plus location. Myth will talk about this later, but the median income's in the low six figures. So it's an affluent part of Arizona, of Phoenix area. And right across from it is going to be a new civic center. We'll show you pictures shortly, but it's going to be amazing Class A office and other amenities right next to it. It's literally across the street. We're buying it for $222,000 a unit, which sounds like a lot, but they sold another property a couple miles away in August of 2022, so not that long ago, for $326 a unit. So we're getting a humongous discount. And that's mostly because of interest rates, but we know that in a couple years, interest rates are going to be a lot better. There's Even though it's brand new construction, there's a lot of opportunity to invest into the property to do value add. For example, we're adding washers and dryers to all the units that don't have them. The 2 bedrooms have them, but the 1 bedrooms and the studios don't. However, they already have the connection, so we're actually just buying it and putting them in. The developers are a little funny. They have a bunch. They rent them out to the tenants, so you can pay and rent them out, and they're doing very well. So we know the value's there. And because of the low price per unit, we think this property is very recession resistant. That means we can go up and go down on the rent while still making a profit. So it really adds a level of flexibility that you don't see on most properties. So on the right-hand side, you can see the median rent or the average rent on the property. And it's a lot lower than the area of Goodyear. So without doing anything, we actually have a lot of opportunity to increase the rents. And who we're actually targeting, we're targeting the people that are getting priced out of housing. So unfortunately, because of interest rates, the price of a mortgage, even for a similarly priced house, is just so much more. So for example, my house I bought in 2021, if I bought it right now, same house, nothing has changed with current interest rates, I'd pay an extra $6,000 per month. This is not some mansion, it's just a regular normal house here, but it's in Los Angeles. So the difference between owning a house and paying mortgage and interest rates and insurance and all that stuff, and being able to rent ours is huge. And that's kind of who we're targeting, kind of the professionals. So as we mentioned, we're getting a great discount. It's $21 million. So it's actually listed for 85. We offered initially 55 and they said no, but they didn't say no super loudly. So we've been able to whittle them down and get to the 63.5 number that we got. And actually, there was a lot of competition at that price. And they went with us because two things. One, they realized that most of us are physicians and we have a steady salary, so we're more likely to close the property. But also, when they interviewed us, it's kind of like multiple dates. And at the very last one, they said, "Hey, you guys are in the running for the last deal. It'd be really nice if you went to this property before it was best in final." And literally 2 hours later, Myth was at the property with the broker. And that's how we closed the deal. We're willing to do things that a lot of people aren't. The other buyers were private equity somewhere else, and they didn't care enough to go visit this property immediately. So the as I mentioned, the developer, the builder is running this property and they have pre-leased it to 91%. So it's 91% occupied, which is actually really good for a developer because this is not their forte. And we know that within a couple months, we'll be able to bring it stabilized or above 90%, 95%, sorry. And because there's a lot of demand already, and the developer is actually doing a pretty decent job. We like property management. This is what we do. So in terms of returns, we're expecting a 13 to 15% return. IRR, that's after all our fees and promote and everything. But the real reason that we're doing this deal and the reason that we love it is that the year one cash flow is 3 to 5%. It's actually already cash flowing, so we're expecting to send out the first check within a couple months. And we think right now, cash flow is king, right? So we know that if the property is doing well enough that it could cover all its expenses, that it has a nice big cash reserve, and we can send money off to you on a quarterly basis, that the property can really handle anything the world throws at us. And honestly, it's a crazy economical world right now. And we really are focused on two things: capital preservation and cash flow. And this really hits the mark for both of them. And I don't know about you, but I keep hearing about interest rates every day. And who knows what the Fed's going to do. Last year, we went up 10 times on interest rates, the fastest in 40 years. So we're getting a fixed long-term loan on this property. So it'll be low 5%, and it's agency debt. So we're really excited about being able to qualify for this loan because not everyone does. And Myth will talk a little bit about why we were able to get this specific loan. So this is laundry room, electrical charging. And here we want to just talk about how we're going to increase value. Because a lot of times when you think of Class A, you don't think about value add, right? But there are opportunities, especially because we're buying this directly from the developer. So there is a lot of opportunity. So one, just increasing occupancy, right? Just getting more people into rooms will increase the net operating income by a ton, right? If they're getting rid of concessions and just leasing it up to where we know and where the rest of the Goodyear area is. We're adding washers and dryers to all the studios and the one bedrooms. That's something that everyone pays for, right? Especially in a more upscale building as this one. They already have connections, so we're actually we're just buying them and putting them in. It's not that difficult. And here you can see in the background that there's 2 laundry rooms. There's one and then a second one that's very similar. And we're gonna turn those into rentable units. So income producing, right? So something that doesn't really make you much money, right? A couple coins here and there, but it's gonna be income producing. So say they're both on the lower end. Say they're going to be both studios, right? So let's say about $1,500 in rent, so $3,000 a month times 12, that's $36,000. But if you divide by the cap rate, kind of how much a dollar of income is worth, around 5, that's adding around $750,000 in value, just by doing these two things. And if you also convert the model unit, then that's almost an extra $50,000 a year in income, and divided by the cap rate, you're adding about $1 million in value by just doing those three things. That's before we really change anything else. So we love the Phoenix market. You can see how many people are going into there, and they're really chasing jobs. So you guys have heard of this large semiconductor bill in the government that passed. A lot of money and a lot of jobs are going to tech that are there, and in the next 5 years, even more people are going to be there. So one thing to keep in mind, in about 4 or 5 years ago, there was a glut of new construction, and they're going to come up in the next year or two. However, we think the net absorption, the amount of vacancy of new units, is actually going to be pretty low. And that's why we got a 5-year loan on this, and the business plan is 5 years, because after the next year or so of new construction, there's going to be very few new construction. That's for a couple reasons. One, bank crisis. So you've heard of Silicon Valley Bank and all these regional banks. They're the people that give money to new construction all the time. And they're going to be very wary of giving loans to people that are high risk, and all new construction is considered high risk. Rates are crazy for construction loans. So the amount of people that are going to be able to afford that is very slim. So we know that once we get past this, that will be fine. But because of the price per unit that we're getting for this property, we are going to be able to outcompete all of this new construction that's coming live. So we can go down for the 2-bedroom, for example, to 1,600 and still make a profit, when everything else that comes out brand new is going to be 1,900. So that gives us a lot of flexibility. So yeah, mentioned that. The average per unit across the Phoenix area, this is even adding the value add, is 270. So we're even getting a discount from that. So the cap rate is something you often hear about when you talk about real estate, and it's basically how much are people willing to pay for income. So if you think of Los Angeles, you get higher rents, but you have to pay a lot more for it, right? So people know that they're going to be willing to pay less for the same income, as opposed to Detroit. It's a lot higher risk, right? So even if you're making $100 in rent, you're going to be like, man, I'm going to pay, like, let's say $50 for that $100 worth of rent. While in LA, you'll be like, yeah, I get $100 of rent. I'll be willing to pay $100 for it. So we are buying it. Our cap rate that we're buying it for is around 4.6. But because the developer is not able to lease up, it's not able to get it occupied for where a property of that level is, actually stabilized, it's closer to 5.3. So that means we're paying actually not that much for the amount of income that we think we'll be able to get in about 2-3 months. So in terms of value, or the price we're paying per dollar, it's actually great. And it just kind of goes to show that for all these reasons, like, we really think this property is recession resistant, right? More cash flow in your pocket, low price per unit, and the debt that's fixed. So couple things to talk about in terms of kind of the more general market. So we'll talk about inflation on the next slide, but I just wanted to mention some of these other things. So stock market volatility. Actually, my wife had to tell me to stop looking at the stock market in our portfolio, because I was just telling her, I was like, 15% down today. Okay, now it's 25% down, 30, right? And then it'll go up, right? And there's just so much volatility right now, because stocks will go down for whatever reason and then go up for whatever reason. So it's nice to have an income producing property as a hedge, right? So I'm not saying take out all your money from the stock market, because right now is a very bad time to sell. But put something in something that's income, right? We're providing housing. It's a basic need that's different from the stock market. Rising interest rates. We talked about that briefly, but we have no idea what the Fed is going to do. People think that rising interest rates will plateau for a little bit and potentially drop in 2024, but it just really depends on inflation. And inflation was supposed to be transitory, which is what everyone told us, but now it isn't. And if for some reason it ticks up or the inflation also plateaus, then potentially we can see interest rates rising again. But we'll be secured against that because our interest rate is fixed and it's from the government, 5% for 5 years. And a possible recession. There's concern that we might be in recessionary times. So having that flexibility and a low basis or purchase price is it's really key, because that's something that you can never change. No matter what, you can always change your loan, you could always change other things, but you can never change the price that you pay for something. And that's what we've seen. We've seen people overpay for things in the past couple of years, and you really never get out from under that, right? It's starting at the -50 line if you're running a 50-yard dash, right? It's just putting handcuffs on yourself. So just a couple points about multifamily in general. So housing is a need. It's a basic necessity. We're seeing a reckoning when it comes to office and even retail. I don't know about you guys, but a lot of times I will get groceries delivered because it's so much of a hassle trying to pack my 4-month-old. So it's hard to say what's going to happen with some of the other asset classes, but housing, especially apartments, have been doing well historically. And that's because we can raise rents up and down on a pretty quick basis compared to everyone else. And right now, people are looking for places to put money, right? So, stock market, private equity is going down. When's the last time you heard of a IPO, a company going public? And because of that, people are looking for safe harbors, and multifamily is one of those. And typically, in, it's actually good for inflation because your rents will typically go higher than your expenses. And so that's called the expense ratio. So you have an expense ratio of your revenue over expenses, usually less than 50%. So for every dollar your revenue goes up, maybe your expenses will go up 40 cents or, up to 60 cents. And so the buying power of private equity, of real estate, has just gone really well in terms of returns, and it's been risk adjusted, and actually returns have gone up, especially over the last couple years that inflation has gone bad. So just a couple words about West Valley. So it's Goodyear. It's one of the 10 fastest growing states. What we really are focusing on is demographics. So young professionals, here you can see the median income is 123,000 compared nationally to 71,000, and even in the Phoenix MSA of 95,000. So we have white collar professionals, a lot of people with bachelor's degrees. We are looking at, young professionals, young families, and there's just a lot of growth in the area. So overall, for demographics, we love Goodyear, and it's actually a place that we've been trying to invest in for a while. And here's a really big thing: the Goodyear Civic Square. So this is going to be the new City Hall, Class A office, a lot of amenities, and it's going to be amazing architecture. And you could see here, this is the building that we're buying, and this is the Civic Center. So it's going to be 100,000 square feet of Class A office space. There's going to be a ton of retail. So there's going to be just so much opportunity for all the people that live there to have something within walking distance, and Class A within walking distance. So it's just going to bring the area just so much higher quality. Quick thing about housing. So the housing in the area, to buy a house, 640,000. We mentioned it's going to be about $2,800 in mortgage payments, interest, and insurance. So unfortunately, a lot of people are getting priced out, and they're seeing the amenity package and all that we're offering at our property, and willing to live there and happy to live there, and almost have a house or experience. So here you can see some of the different job opportunities and retail that's in the area. So Amazon, Goodyear, UPS has a humongous uh, uh, office there. So a lot of economic area. I'll let you read all this. Amazon is one of the top employers. So is the county, UPS, Marshalls, and so on. Chewy as well. So here is the loop. There's new infrastructure. I'll leave this to you to read. And lastly, we wanted to focus on the healthcare. There's 11,000 healthcare professionals that are in the area. There's a couple different hospitals, including the Children's Hospital that just got this almost $40 million expansion. So we know that there's a lot of value, and a lot of people outside of us have faith in the area and have been investing billions of dollars to improve it. So, Phoenix Children's Hospital and so on. So next, I will give to Myth to talk about a little bit more about the details.
Thanks, Pranay. So really excited to share this property with you. So let's kind of go into some of the numbers and the financials here. So as you know, called Cabana Encanto, it's 286 units. So the property was built in 2022, started getting its first residents in April. And so what they started to go through is called the lease up phase. So basically you can imagine as one building, it's 5 different buildings, as the buildings started getting built, they start leasing the first one and the second one, the third one, and so forth. So right now the building is currently, the entire community is 84% occupied. So that's really good. But part of our sales agreement with them is that they have to get to 90% occupied, or what's called stabilized. And so they're going to really have to push and get themselves 90% occupied, but still for us in that submarket, 90% is actually not par. And so we can really get it into that higher range of 95%, where we like to see most of our properties. One of the really cool things about buying a 2022 new build, and this is what Pranay touched upon, is we actually qualified for a special agency loan. It's called, it's a green agency loan. And so Fannie Mae and Freddie Mac, for certain properties that meet these energy requirements, they'll incentivize you to do so and build to those specifications by giving you more loan proceeds and also a lower rate. And so for our specific property, Cabana, we were able to get 20 basis point reduction in the rate just because we're building a property that has, you know, a better carbon footprint. And they also gave us $800,000 more of loan proceeds, meaning that the loan which they would have given if it wasn't a green property, we would have actually gotten less from the government for that property. But since they really appreciate and want us to be building more environmentally sound properties, they were able to give us more. And so it's a really nice incentive and really speaks to kind of what we want to be doing here at Ascent. All right, back to the business plans. Pranay really touched upon this, but I've had an opportunity to talk with the new property management company that'll be taking over for us. They're called AMC. And what's great about them is that they've already taken over 3 Cabana properties. So Cabana is the brand name that the builder uses. And so they've already taken over 3 different properties. And so everything they're doing is kind of rinse and repeat. It's the 4th time they'll be doing it. And so they know all these things will be effective. So adding the washer and dryers. I can't really understate the value of converting the laundry rooms into new units, and then also the model. So right now they have 2 model units. One of them was a studio and one of them was a 1-bedroom. But, you know, to be honest, you really just need one model unit to kind of really show off the different the prospective tenants, like what it looks like, and have it nicely staged. So we're going to convert one of those units, those mall units, into a rentable, leasable unit. And so that's where all the value is coming. And those are just such low-hanging fruit that we can institute right away in year one. Also, some of the amenity package we'll just update a little bit more as well. AMC specializes; they're a big management company, 20,000 plus units under management. And so they have a really specialized way of doing bill back. And so the developer right now doesn't charge for utilities. They don't do RUBS. They don't do common area utility bill back. They also don't charge for some of the more common things in this submarket, which includes real estate taxes. And so all of these things which we're describing, not only have they done at other Cabana properties, or 3 other properties, but they've also done within this Goodyear submarket as they own and manage as well in the exact same pocket that we'll be in. So these are all things that we know the submarket is used to and is also able to get the numbers that we want. All right. Going back into the unit mix. So the unit mix is actually really nice. We have a mix of studios, 1 bedrooms, and 2 bedrooms. The studios are unique in that there's only one other property that has studios currently in the submarket. So they think there's going to be a lot of demand there. And I shopped all the comps and I agree there's going to be people want to live in Goodyear, but maybe they don't want to live with a roommate and they can't afford a house. And so a studio is really a great way to have the super nice amenities of Goodyear, be in that little pocket of Phoenix at a lower price point. So the big thing about this property is if you look for the current ask and then year one, which is 1 year from now, even though we're going to be doing all this value add, we're going to be adding in-unit washer and dryers, updating the amenity set, doing all these other things, we're actually only asking for a $50 to $60 increase. And so we will feel really confident that we're going to be able to achieve these because it isn't that huge value add lift, as it's called, where you have to get $150, $200, and sometimes even $250 to $300 from doing this huge renovation scope. These are smaller and much more tried and true. So it takes a lot of the risk out of it. And so that's one of the really big key things I would like to highlight. So this is the exact cost for the renovation plan. So obviously it's gonna be cost money to buy the washer and dryers, and also the different things we're gonna do. So we're gonna update the common areas with additional features, dog park, cornhole, barbecue areas, and again, converting the laundry room. The leasing office right now, they don't have separate little offices so that a prospective tenant could go sit inside an office and more privately discuss versus being in the open area. So we're going to do that. We're going to add a signage package, add in landscaping, which is more in line with our brand. The total renovation budget will be $1.8 million. So this is the sources and uses. So the exact equity stack is, so we'll be providing $22 million worth of equity, and then we'll be getting our agency loan, and then there will be a preferred equity piece, which is for $12 million. The preferred equity piece is actually going to be through Related. So Related is a company that we've done 2 previous deals with. They're one of the biggest New York financial institutions. And so we have a great relationship. I have a great relationship with them and their executive team. And so we brought them into this deal to be able to provide us with $12 million of equity, and they really believe in it. And so it's just another stamp of approval to say like, hey, yeah, we believe in this deal. So the total loan to cost again is going to be around 68%. So these are the uses. And so just to go through the exact numbers, so the total acquisition price is $63.5 million. The price per unit is $222. And then our acquisition cap, so the acquisition cap is based on right now. So it's 4.57. So right now today, but we know that when we take over the property, it has to be more than 90% occupied, not the low 80% it is currently. So when it gets to 90% occupied, it'll actually be closer to a 5.3% cap. We're not there yet, so that's not actually the acquisition cap, but that's where we're going to be, and that's stipulated in our PSA or purchase sales agreement. So we'll only take it over when it's above 90% physically occupied. Going through the loan terms, again, really important. So this is a fixed rate loan. Right now, our current quote is 5.32%. That exact number gets locked in. It's called a rate lock, and that'll happen closer to closing. So there could be some variability there, but that's our current quote as of today. So a 5-year term, 5 years interest only. Again, our preferred equity partner is called Related. This is our third deal with them, interest only. The hard pay is what we need to pay them. Every single month is 4%. And then by exit, they need to be at 12.25. This is actually significantly cheaper than all the other quotes we got. We got 14%, some is even as high as 16%. But I mean, obviously we have relationships, so we can kind of get the best terms. I really wanted to put down here what the projected exit is. And so we have a 5% exit cap, but the price per unit on exit of $307,000. What is really incredible about that is we've already seen a property, and I'll show it to you, where they've exited for $326 a door. And this is the exact same property in terms of layout, units, everything. So if you can imagine, we're saying 5 years from now, we need to get to $307,000. But a property in August of 2022 in an inferior location actually already sold for $326. And August of 2022 is actually not when peak pricing was. Peak pricing was probably closer to January and February before interest rates moved. This is all in 2022. So we're really confident about this. When you see something, when your exit price is actually below where it's already sold from, that is a really, really big selling point. And this really reiterates what Pranay is saying. You can never change the price you pay per unit. Like, that's stuck. And so the debt can change, the leverage can change, all these things can change, but your basis, as it's called, that's the one permanent thing. And that's what's really good about this deal. Okay, so here's the pro forma. So again, 5-year hold, using T3 income, T12 expenses. One of the things that people always ask about is, where are the big changes? And so vacancy, as I told you before, this T3 is an average of the last 3 months. And so here you're looking at the average vacancy was 15%, 16%. We know that it's going to be 90% when we take over. And then so we're saying that we're going to be able to bring that from a 10% vacancy down to a 7%. And that's why you see this number dramatically reduce. Concessions as well. Bad debt here is positive because during those 3 months, they were actually able to get some refunds back. So that was just the average. And so that's what we had to show. Another big item is the other income. And so all these other income items, what has happened is AMC and our partners, Sunrise, they've been able to do this in the exact same submarket and similar Encanto products. So we know that we can get this increase, and that's going to be common area bill back, the tax, late fees, and month-to-month premiums. So all this stuff, this increase, we're really confident about because we've done it before in 3 other properties, and so this will just be the 4th one. So we're increasing payroll and expenses because we really want to be able to have the best staff. We've already identified the property manager, an assistant manager, and getting our leasing agents and maintenance staff together. But we think this is a high value where we can get the best people who can do the best job for our property. And so we really want to pay for that. Property taxes in Phoenix are actually pretty formulaic. And so the first year you'll see it's 146, and then it steps up in the second year. And that's just the way it works. And so then going down here, I really want to touch upon this. And so this is the debt service coverage ratio. It goes from 1.83 to 1.97. The reason why it dips down is that our preferred equity partner Related, we talked to them and we really wanted to be able to get the best terms. And so what they're going to do for us is, for the first 2 years, we're actually not going to pay their 4%. That'll be paid from an interest rate reserve. And so we start paying for it in year 3. And what that gives us is really great stability, because the first 2 years, the property acquisition are normally the ones when you have the most risk, the most operational risk. And just because of the relationship we have with Related, and their belief in the property, we were able to do this. And so that's why we're having so much. We just basically have to pay that agency debt off in the first 2 years. And then after that, we'll start paying Related, which is the preferred equity partner. But that gives us a lot of confidence in that when we're getting the property up from 90% to 95, 97%, we can really do that. We can be strategic and can spend money where we want to. And then in year 3, when the property is stabilized, our operations are there, we've turned over the tenants and put them on the new rental contracts, which have the tax bill back and the CAM bill back. Then we'll start paying Related back as well. Here's a sensitivity analysis going over rent growth. The way sensitivity analyses work is that you have to do an average. So this is the average of years 2 through 5. So year 1, we're projecting rent growth to be 1.5%. RealPage is saying that it should be 1.9%. And then after that, it'll be a more classic historic numbers of 3, 3, 3, and then 4 in the final year. So you can go through the sensitivity analysis, looking at cap rates, cap rate expansion, cap rate compression. Oops. Here, the sales comps, and I really wanted to kind of zoom in on this one particular piece of it. So we're Cabana Encanto, and then you'll see the 2 other Cabana properties, Cabana Power and Cabana 1990. And if you see here, this is in Glendale, which is a market we know very well, but it's not quite as nice as Goodyear. You can tell in August, they sold this property, and this is identical, 286 units, identical in every shape, every unit composition, the amount of units, square footage, complete identical product. They sold it for $93.5 million. So after they did this, they were so confident in their product, and that's why they were initially asking for Cabana Encanto, $85 million. But what I said before is really important. We only need to get to low $300,000 a unit, not this 326. So this is what gives me a lot of confidence in our exit numbers, because we know in 2022 in August, when this is not peak pricing, we just have to get to a number less than that 5 years from now in a better market. So you can kind of see how everything else is traded. A 1998 product is traded for $422 a door. The one thing is we have smaller units, 603, but that's why we looked at the price per square foot. You can still see the price per square foot is well under the comp set. So you have to look at both things. So the price per unit is really, really low, and the price per square foot is also really low. And so our debt team on our side was like, when they saw the price, they're like, you guys have to get this deal and close this up as quickly as possible before they realize that the market is much more competitive. The builder is a relationship that we've had through our partners, and they're builders and they have such high costs of keeping this property because of the loans they have. They really want to be in and out and start their next development if they can. So they were really motivated to sell. So again, showing our Cabana property, and then you can see the other Cabana property that sold at 99th. And this other property is called Cabana Power. So this is in Mesa. Obviously, this is not in the same sub-market. It's in a really nice market, but that was the other Cabana product that had sold. Okay, here are the rent comparables. And I just want to touch on this briefly. You can see our rents are well below the market. And we always want to be positioned where we can be less. And so because our purchase price and our debt service is so low, we can really cash flow the property really well while toggling up and down on the rent. So obviously we'll try and push the rent as high as possible. But if there's a widespread recession, we have the ability to weather that because our debt service is so much lower than our competitive set. It's just showing where they are. So our pro forma rents, so this is the rents we want to get to, are 1,400, 1,600, 1,800. And you can still see we're well below this. For the studios, there's actually not a ton of studios in the market. So we believe we can actually push the studios above market. And the studios currently are actually well rented out, and there's not a lot of vacancy among the studios because people really want to have a affordable option to live in Goodyear. Again, just going through the comps. The Phoenix market, which we really believe in the macro demographic viewpoint here. This is our track record, in case you don't know. And this is our second deal, which we'll be doing with Sunrise, who's the operating partner. And our first deal, I'll go through a case study of. This is Sunrise, Ian, and MD. They're absolutely great. We're on weekly calls with them about our previous property, and we'll continue to do that. So this is AMC, who is a property manager, and they're kind of the boots on the ground. Again, they have 3 other Cabana properties, and our one will be the 4th. Okay, so this is the other property that we own with Sunrise, and a lot of you are probably invested in that deal. We're really proud because it's paying off cash distributions, has not missed one. This was our proposed budget and kind of what we wanted to do. What I want to really highlight here is that we've increased our NOI by 14% in just a few months, and we've also achieved our year 3 rents, even though we're only a couple months into the business plan. So as you can see here, this dark blue is the rents we're currently getting. The gray is what we thought we were going to get with the underwriting, and then this is the pre-acquisition rent. So you can see how much of the value we've created here. And this is just the different types of unit types: a 3 bedroom and 1.5 bathroom, and a 3 bedroom and one bathroom, with the R being the renovated type. So this is a relationship that we have with Sunrise, and we feel confident about our ability to execute together as a team. All right, I'll hand it back over to Pranay.
Thanks, Smith. Yeah, and just can't really emphasize that we bought that property in November of 2022. The first check went out in January. So light speed, and has been consistent since then. So that deal is doing very well, which is why we rushed at the opportunity to be able to work with these group again. So here's fees. So there's a 2% acquisition fee. There's a startup fee that's only in the first year, 2%. There's an ongoing management fee, and this is kind of important. It's on gross income. So that means we take it against stuff that comes in. What I have seen a lot in the past is that they have a flat fee that's based on money invested. So this is nice because if for some reason there's a month that the rental income is down, that it scales down as well. So this is something that we've been doing for our last couple deals. If there's a potential refi, because this is an agency debt, it's going to take a lot more work than it would for another refinance. So there's a 1% fee. And disposition fee, a fee that you pay at the end, there's none. We're not going to charge a fee at the very end. And here's our waterfall. We try to, people ask me about this all the time, but we try to keep it really simple. Okay, so the baseline, say you invest 35,000, you will get 8% preferred return, then all your money back, and then 75-25. Another way to look at it is if there's a if it's a 5-year deal, you put in 100,000, that means I owe you 8% per year, so 40,000, then all your money back, so 140,000 at the end, before we see a single dollar. And we think this is very investor focused, being investors ourselves. As an investor, you're taking the risk by giving up control and trusting us. And we think you should be rewarded by a majority of the money that comes in out front. And that also means we believe in this project so much that we're willing to be the very last people, eating last, as you'd say, and having our money in the 25%. There's no property level waterfall. This is the only waterfall there is. And our minimum is 35,000. We try to keep it very attainable for even hospitalists like myself. But we also give some extra benefits for people that are willing to invest some more into the deal. So if you're willing to put in 250 or more, you get 9% preferred return. The rest of the waterfall is the same. Over 500, 10% preferred return, and over 11% for if you put $1 million or more. And that's in total. So that's our thank you as helping us with the deal, because as much as we'd love everyone to get into this deal, we really try to provide a really high level of service. People are surprised how often I pick up the phone. Actually, I was talking to an investor right before this call on a Saturday, but we really, we understand that regardless of how much you invest, and even 35,000 is a lot of money for us. So we want to give you and everyone else a high level of service and an extra benefit if you believe in the deal and are willing to put in more. So a couple frequently asked questions. If you're interested in retirement accounts, we can take it. You need to have a couple different types. You can have an EQRP, which is also called a checkbook LLC. You can have a self-directed IRA, and you could have certain solo 401ks. So please reach out to us if you want to invest like that. The deal itself is 5 years, and because it's fixed debt and there's a prepayment penalty, we really should expect to be in the deal for 5 years. Of course, if there's a great opportunity, and we'll always look at it. We'll always start looking at opportunities to exit starting year 3-ish, but expect the money to be there. Distributions are going to start in a couple months. So we're going to close the deal, and it takes a quarter, right? It takes a couple months to get it going. So early Q4, so end of Q4 or earlier. And we'll make distributions every quarter starting at Q4. Yeah, next. And reporting, people are surprised by how well our reporting is. And we report every month. Most people do quarterly, but it'll be quarterly if you want, but we do it every month so that you can see occupancy, you can see everything we're doing. Because we're actually on the phone with our property management every week, and we walk the property every month or two ourselves. So we are very, very hands-on. We're not like other groups that will raise money for a deal and kind of disappear. We, trust but verify. I tell people I'm like a hospitalist or a primary care doctor. Like we have all these consultants, we have all these people we trust, but at the end of the day, we're really making sure that what we want is happening. And if you know these deals, there's a preferred return of 8%, but you usually don't hit that until the very end. So you'll get anywhere from 3 to 5% in the first year, goes up a little bit after that, and you get half or more of your returns at the end of 5 years. And so we're expecting around a 1.8 to 2 times your money in at the end of 5 years. And that's after all our fees and promote and everything. Yeah. And so that's it. That's the deal, Cabana Encanto. Couple things that we really love about the deal. Brand new construction, 2022. Takes a lot of risk off the table because we don't have this heavy value add. We're going to add simple things. like reserve parking spots, washer dryer, convert units, convert laundry units into income producing units. That's a very rare opportunity. We jump at that for any one of our properties. The low price per unit, so the basis, like Myth said, we've already seen value with current interest rates that people are willing to pay for this property, almost $100,000 more. So we want to get there in 5 years. So we just have so much opportunity to increase value before that. And hopefully we surpass those numbers. But we always want to underwrite and predict a lot more conservative numbers. 3, cash flow. The property is making money already, even with these builders that don't necessarily know how to run this type of property, right? Like Myth was saying, that they want to go in and go out. They have very expensive construction loans, and they don't expect to run this property, right? It's just like if someone were out building houses, they don't want to live there, right? They don't want to rent it out. No, they want to build it, sell it, build another house. And then the debt, the fixed interest rate with agencies, so with the government, it's actually really, really hard to get. We were able to qualify because it was a new construction, has a lot of green initiatives. And plus, we have worked with them in the past. We actually got underwritten. We had to send them all our information, and not everyone is able to qualify for this type of loan. So that plus the preferred equity, who we worked with, it's really a big stamp of approval if this company related trusts in this project so much that they're willing to put in preferred equity. Preferred equity actually right now across the board is in super high demand. So they can ask for sky high fees and returns, but they were able to give us modest ones because they believe in this property so much. So we love this deal. We've kind of been on the sidelines for a while, since November, looking at deals, looking at like 3 to 4 deals a week, and really nothing got us excited. And this deal was, it just really hit all the check boxes, and cash flow, capital preservation, equity growth. And especially in this kind of recessionary times, this is the type of deal to do. But if we get the soft landing the Fed's talking about, then this is going to be a home run. But we're really aiming for a double or triple. So if you guys have any questions, I'm really easy to get a hold of. Info at ascentequitygroup.com. If you want to find out more about the deal, ascentequitygroup.com /deal. Thanks. Talk to you soon.
Thanks, everyone.